will start the presentation now, thank you. So I am with Fast Markets. We are a price reporting agency for the commodity markets. Price reporting agency means that we have a team of over sort of 700 people in the company, and our job is to assess markets, assess the prices for different sort of commodities. So whereas you can find out what the copper price is by looking at the LME price or the CME price or the Shanghai price, there are thousands of other prices out there which need to be assessed, and that is what our price reporting agencies do. And a lot of our prices are then used in contracts. So down the supply chain, our prices would be used in contracts. On top of the price reporting, we also have an analytics team, and that's where I fit in. So we cover the base metals, we cover the battery raw materials, we cover the forestry products, timber products, and ags as well. But my focus is on the metals. So today I'm going to be looking at the battery raw materials outlook. Although there are challenging times at the moment, we are still very bullish on the overall outlook. So I think the recent headwinds we're seeing in the battery raw materials only really reinforce the need for investment and expansion. So the areas I'm going to be covering today are the supply surpluses we're seeing now, and how those are creating problems for tomorrow. I'm going to look at the huge demand potential, and then look at the markets and why we need a more balanced supply chain. So currently, the markets are here. You can see charts for lithium, cobalt, and nickel. And you can see we're currently seeing the markets in a supply surplus. But as you can see from the chart, as we drop below the zero line, we're going to be facing some significant deficits. Now, obviously, you can't have year after year after year of deficits. So we need investments to fill those gaps. At the moment, production is still expanding, but the price volatility we've seen and the low price environment does threaten the timely arrival of new supply. And in difficult times, as we're in at the moment, China is a lot better at sticking to its investments than the West is. And China has led, and it dominates, the battery raw material processing and the downstream manufacturing parts of the supply chain as well. And a more distributed supply chain is needed, creating the opportunities for this region and around the world as well. So moving on to looking at the demand outlook. Last year, 2024, was generally seen as a weak year for demand for the battery raw materials. But it was only relatively weak. Global lithium demand grew by 33%. Now, that's an incredibly strong market, really. The problem is the market has been used to triple-digit growth or high double-digit growth, so they'd anticipated for that. And then when you see sort of 33% growth, you have sort of oversupply has been created. And the areas where we generally saw weakness in EVs has been in Europe, and we actually saw either flat or slightly negative EV growth last year. But we think that will be temporary. And one of the reasons for that is that Germany and Norway and France changed or cut their subsidies for EVs at the beginning of last year. And as a result of that, that hit the sort of demand, the uptake of EVs, and obviously the cost of living crisis was another factor there. But if you look at what happened in China in 2019, they also cut the subsidies, and in the second half of 2019, EV sales started to fall, but it was only temporary. By the end of the year, EV sales started to pick up. Obviously, then COVID came along, and it was all sort of put on hold for a bit longer. But this chart is an interesting chart. It shows the global primary energy consumption by source. And if you look at the top bands, the colourful bands, that's all the energy we're currently getting from renewable energies, where the grey, the darker grey, the black and the dark grey are all the energy we're getting from fossil fuels. So in 2023, 84% of our primary energy came still from fossil fuels, with 16% coming from renewables. So that really does highlight there is room, massive room for growth for renewable energy generation. And most of that heavy lifting will come from solar and wind. And if you're going to rely heavily on solar and wind, then you need energy storage to go hand in hand with that. And therefore, the lithium-ion batteries are going to be a critical part of that. So if we look at sort of the lithium demand at the moment, you can see the majority of it the growth has come from the purple area on that chart, which is going into EVs. And as you can see from the table, you can see the very strong, generally very strong compound average growth rates. So for lithium demand, from 760,000 tons LCE in 2023, we're looking to that to move up to 3.6 million by 2034. And if we break that down, if we take out the EV part of that, then you can see the really strong growth coming from energy storage systems. And also other areas are also showing generally strong growth with power battery swaps as well. And if you look at the table there, so most people are thinking EVs, so we're looking at 16% compound average growth rate, but energy storage from a low base is going to be looking at 22%, and then battery swaps are going to be growing fast as well. So when we're talking about battery swaps, we're talking about instead of recharging your EV when you're parked or when you're at a garage or when you're at home or at work, you actually go into a service station and they swap the battery out, so it gets rid of that sort of range anxiety or the gaps between the time it takes to recharge the battery. The traditional use there, we're seeing as flat, and that's mainly for things like greases and ceramics. And part of that is because of the high lithium prices we've seen in the past. That sort of caused substitution out of that. And it's just the other markets are just growing so much stronger. So demand is set to grow at a very strong compound average growth rate. And that strong growth is going to be global. And it means it will be hard for producers to keep up, especially in Western markets. So if I move on to the third area, sort of why we think the market requires a more balanced supply chain. So if you look here, you can see these are the prices of the battery raw materials going back to sort of 2018 or 2019. You've seen a significant run-up in prices in the post-COVID era, and that was as countries started to kickstart their economies, and a lot of that was sort of focused on sort of the green transition. But you also had supply disruptions as well. You had shipping disruptions, you had movement of labor, some of the idle capacity that went idle in 2019 and 2020. That was hard to reactivate because of the restrictions on labor movement and things like that. But what you also saw, as you saw those massive price increases, was a very quick supply response, mainly from China. You also saw there were other areas as well, but you saw China responding with its investment in its lepidolite, but also shipping direct ores from Central Africa to China as well. But this has made a very difficult sort of situation for producers generally to be operating in. So these low prices are a big threat to the future supply. So the headwinds are coming from, we've already seen miners have had to cut or halt production. That's mainly been seen in the West, but we have seen some high-cost production, lepidolite production cut in China as well. We've seen lithium, cobalt, nickel, and graphite have all been impacted. And one of the sort of crucial things is it's actually the investments have slowed down in these areas. They've either been delayed or in some cases they've been stopped. And much of the areas where it's either been delayed or stopped has happened in the areas where we're going to need that supply, that local supply in the future, mainly in the US, Europe, and in Australia. But this low price environment hasn't been such a headwind for China. They can take advantage of it. They have been less affected. They continue to invest heavily in Africa, in Indonesia, and in Bolivia, and within China itself. So China continues to gain market dominance at the expense of the other areas. where demand will be high and domestic supply chains are needed. So if we look at the impact of the low prices on the various commodities, here, as I mentioned already, Chinese and non-Chinese production cuts have been seen. Mainly China just in the lepidolite, but across Australia we've seen production cuts as well. So this chart shows how our outlook, our forecast for mine supply has changed between the third quarter last year and our more recent forecast in the fourth quarter. So you can see Australia in the purple there has been affected. China has also going to be affected next year more. What we are seeing though is continued expansion in Chile, and that's not so surprising. Chile is sort of the cheapest producer of lithium. But we've also seen cuts to refinery production. We've seen those in Australia, and that is, again, it refers back to what we spoke on the panel. It is just that much more expensive to produce things outside of China. And that is, these delays and suspending and cancelling of projects is a really big risk. It means the West is losing market share to China. But having said that, we are also seeing some production still continue to ramp up, and that's encouraging, but we also need to see more and more investment going into the supply chain. If we look at the cobalt situation, so again, the chart showing the same thing. It's how we've had to change our forecast because of the cutbacks between the third quarter last year and the fourth quarter. And what we're seeing there is that in the Democratic Republic of the Congo, Chinese producers have continued to expand cobalt production. In fact, China Moly, or CMOC, raised production by an amazing 106% last year. Whereas we've seen some of the non-Chinese producers have had to reduce production because of the low price environment. And Glencore, in the first 3 quarters of last year, cut their production by 18%. But on the other side of that, you've had Indonesia. So Indonesia's cobalt production continues to grow because they've continued to invest in the nickel supply chain. So cobalt production last year, we estimate, will be up 70%. And with already low prices, we've also seen cutbacks in Australia on the nickel production, and that's affecting cobalt production as well. And that low price environment is delaying the startup of new projects, and with some projects on hold. So we expect Australian cobalt production to be down 22% last year. And we've also seen in North America plans to increase cobalt production has also been delayed due to the price weakness. So what we're really seeing is sort of the bulk of increases is coming either from the Chinese or from Chinese and their partnerships in the Indonesia or in the Congo, whereas production in the Americas has suffered due to financing issues. And if we look at nickel, again, the chart shows here, on the top chart shows how we envisage Chinese Australian nickel production to pick up, and the bottom chart shows Indonesia. And again, we estimated, because of the low price environment for nickel, some 318,000 tons of nickel capacity will be cut due to these low prices. And you can see Australia has taken the brunt of that. 62% lower mine production in 2025 compared with 2023, with refined production down 58%, and intermediate, so your HPALs, down 100%. Whereas Indonesia continues to see healthy expansion, especially in the intermediates section. So what we're seeing is trying to build localized supply chains is proving difficult. Prices, because the low prices have reduced investments, certainly outside of China. As I've already mentioned, CapEx and OpEx are significantly higher outside of China. And China has the advantage that it has the know-how and it has the experience, and it has been doing this for sort of 10 to 15 years. So it has a big head start across the rest of the supply chain. And I think it's important, especially in things like lithium and some of the other battery raw material salts, is they're not commodities, they are salts, and it takes a lot of know-how to actually get class 1 battery grade material. So China also has the advantage, because it's been doing it for so long, that it also has the economies of scale. And as a result of that, there are barriers to entry. Local supply chains, if we are looking to build local supply chains, then they're going to need subsidies, they're going to need loans or grants to overcome these barriers. The US has the IRA, and that to some extent has certainly promoted and starting to build up the US supply chain, but Europe doesn't have that sort of level of financial support. So what are some of the solutions and some of the and my conclusions? So we do need government and private and international partnerships need to establish these supply chains. The Chinese model is very integrated. It is the state companies, or it is the state plus the companies in very strong partnerships. They have the 5-year plans, so they have that sort of long-term ability to plan forward. And if China needs it, they can find the money for it. Whereas the Western model is very much more, each company is on a standalone basis. So you have a mining project, they will invest in the mine, but they're very much standing on their own, apart from maybe being able to get off-take agreements which will provide help. So the Western companies, although they have these long-term targets and long-term plans, they are, however, vulnerable to the various quarterly reporting or annual reports they have, which can affect their cash flow and then therefore make them change their plans. So again, the US has the IRA, Europe really needs, because it doesn't have the money to invest in these things, it does need federal funding. And as I've mentioned before, the security of jobs is very important in Europe, as is the security of local supply chains and local manufacturing if Europe is to succeed. And it's needed because of the geopolitical risks as well. And then just in conclusion, therefore, so despite the sort of depressed markets we have today, the outlook is still very strong for lithium-ion batteries and all the battery raw materials that go into them. New projects do face delays and cancellations due to the poor investment climate we're currently in. And as a result of that, that increases the geopolitical risks. So we need strong partnerships to enable local supply chains to be built so that we can produce secure, stable, and a balanced green future. And that brings me to the end of my presentation. Thank you very much for your time.